Today's episode of Escaping the Drift is brought to you by Mando. Are you somebody that stinks? I know it sounds crazy. Or more to the point, you got a teenager that stinks? Because, wow, this Mando stuff, they sent me a package of it to try out. And if you've got that weird odor emanating out of your teen's room, try Mando all over deodorant. Because this package they got us, man, I put it on the boy, and I got to tell you, he and his room have never smelled so good. I mean, literally, you can use this stuff all over you. I'm talking about your feet, your butt crack, anywhere you got skin, this stuff will work as a deodorant. It was created by a doctor. It lasts for up to 72 hours. And all of this stuff is baking soda free and paraben free. So if you want to try it out, if you yourself are stinky or you got a stinky teen, I'm telling you, this stuff will change your life. You can get right now Mando Starter Pack, which is perfect for new customers. It comes with a solid stick deodorant, cream tube deodorant, 2 free products of your choice, like a mini body wash or deodorant wipes. You get free shipping, and as a special offer for our listeners, new customers get $5 off a starter pack with our exclusive code. That means that you're getting 40% off of this starter pack. Just use the code GAFFORD when you go to shopmando.com. That's user code GAFFORD at shopmando.com. You're going to get 40% off. So support our show. Let them know that we sent you. Obviously, this is a paid advertiser, which is how we get to be able to do what we do for you guys. So check them out. Smell fresher, stay drier, boost your confidence from head to toe. Try Mando. And now, Escaping the Drift.
The United States only has 11% of its GDP coming from exports. That is the lowest number probably on planet Earth. China officially is at 20%, but that doesn't include all the stuff that they ship to Vietnam and Cambodia that eventually makes its way here. So China, and this is just a guess, is probably at least 30%. Europe, every country in Europe is in excess of 30%, with the exception of Germany, which is over 40%.
And now, Escaping the Drift, the show designed to get you from where you are to where you want to be. I'm John Gafford, and I have a knack for getting extraordinary achievers to drop their secrets to help you on a path to greatness. So stop drifting along, escape the drift, and it's time to start right now. Back again for another episode of, like it says in the opening, man, the show that gets you from where you are to where you want to be. And today we got something special for you guys, because obviously there's a lot going on in the world today. And we wanted to I'm sick of scrolling through social media and seeing all of these pocket economists that, class of Wednesday that know exactly what's going on in the world because they happen to vote one way or another. And I decided to maybe bring you some good information today. So what I did was I went out and we scored a Wall Street legend. I mean, this is a guy who saw it coming when nobody else did. You may know him as the real-life inspiration for Steve Carell's character in The Big Short. And he famously bet against Wall Street in the 2008 housing crash and won massive. But he's more than that. He's a brutally honest guy in finance that calls it like he is, whether it's good or bad. And today we're going to talk about the good and bad of tariffs. Ladies and gentlemen, welcome to the show. This is Steve Eisman. Steve, how are you?
Pretty good. A little poorer, but
a little poorer today. Well,
yeah.
Well, thanks so much for taking time out of your day. And I'm sure you've been busy commenting on all that's happening in the world today. And I do want to talk later a little bit about your experience with The Big Short, but obviously let's talk about the news of the day starting out.
Sure.
So let's jump right into it. What is your perspective on what's going on and where we're going to land?
I think, to use a term that probably no one has applied to this, what we have is a theological problem.
Mm-hmm.
And what I mean by that is everybody like you, like me, in the markets, went to college, and we all at least took Econ 101. And at Econ 101, they taught you that free trade is good, tariffs are bad, trade wars are terrible. And the thing about economics is it's very persuasive because there's a lot of math, there are a lot of graphs, there are a lot of tables, and all that math, tables, and graphs can't be wrong because they have all that math, graphs, and tables. And everybody walks out of, when you walked out of Econ 101, you thought, I really learned something. So we have been living in a world of economics now for a long time, and I think part of the problem is you have to go back to the '90s. In the '90s, President Clinton sold he sold NAFTA and China entering the WTO with two arguments. And those arguments were this will increase GDP and it will create a lot of jobs. And he was 100% right about the former, and he was terribly wrong about the latter. If you have, after the movie, I got a great speaking gig, and I've made speeches all over this country. And let's say I go to university in the middle of Indiana or something. You drive from the airport through towns that have been obliterated, literally obliterated. I mean, half of Main Street is closed. No new home has been built in a generation. And you have to remember that GDP is just an aggregate number, but it doesn't tell you that maybe half the country has suffered terribly from what happened. So I think what President Trump is trying to do, and I have to say great sympathy for this, is he's trying to right a wrong, because after the '90s, we allowed our manufacturing base to go overseas, okay, but we didn't retrain our people. We left them. We said, "It's your problem. You go deal.
Go learn to code. Go learn to code." Yeah, I think was
learn to code at age 50.
Yeah, there you go.
So I think what he's trying to do is two things. He's trying to level the trading playing field, because we are the only ones who seem to play fair. We've had very low tariffs, very low barriers. Everybody else has tariffs and barriers. And he's also trying to bring a lot of jobs back to the United States. And, you could think about President Trump whatever you want. Some people like him, some people hate him. But one thing that I find admirable, regardless of whether you agree with his policies or not, he's one of the few politicians in our lifetimes who actually does what he says he's going to do. And nobody believed this tariff stuff because it's so against what everybody learned in college. They didn't take it seriously. He's just fulfilling his campaign promise. Now, the people who voted for President Trump, his biggest followers, are not big investors in the market. They're the ones who live in these towns. So I think there's a reset about what's happening, and it's extremely jarring because he's not playing by the playbook that everybody learned in college. That's part of it. What I think is also clear is that this is going to take time. And thankfully, and I really mean this thankfully, the United States is in the best position in the world to deal with this.
Well, I know that a lot of naysayers say, well, why wouldn't he not negotiate before?
Oh, that's ridiculous.
Well, I think the best quote I saw was a Kissinger quote who said, "You negotiate once the tanks are rolling," because
exactly the tariffs are the tanks.
Yeah, you have to show power. You have to show power prior to anything happening. Right. So you knew he was going to flex a little bit and get this done. Now, I think that of a lot of the people that are making the most noise, who is the most susceptible to fall first in this show of power for the United States? Which countries do you think get in line the fastest?
Okay. So let me quote some statistics.
Okay, perfect.
The internet is a great thing for research, as we know.
Depends on who's talking.
I got these statistics in 10 seconds.
Okay.
So the United States only has 11% of its GDP coming from exports. That is the lowest number probably on planet Earth. China officially is at 20%, but that doesn't include all the stuff that they ship to Vietnam and Cambodia that eventually makes its way here. So China, and this is just a guess, is probably at least 30%. Europe, every country in Europe is in excess of 30%, with the exception of Germany, which is over 40%. Mexico and Canada are each 35% of their GDP comes from exports, and here's the kicker, 25 points of that 35%
comes here.
Is exports to the United States. So if we are working under the assumption, and believe me, it's a big assumption, that everyone is going to act rationally, everybody would come to the United States cap in hand and say, okay, listen, all the stuff that we've been doing, jiggering the trade in our favor, game's up. Let's try and negotiate as good a deal as we can. That says everybody's rational. Now, everybody's not necessarily rational. Politicians want to get reelected. They might be afraid that they might be afraid that if they cut any deal with President Trump, they're not going to get reelected. So I can't handicap that. I can only say that if they're rational, deals will be worked out. I do know, because I have a very good friend who runs a hotel in D.C., that the hotels apparently in D.C. are filled with ambassadors from all over the world asking to negotiate. So I thought that was pretty nice information that I got this weekend. But I don't know how it's going to play out. My guess is most countries will cut a deal. Mm-hmm. It may take a few months to cut those deals, but most countries will cut those deals. China may not cut a deal. China may say, this is just a form of war and we'll deal. That I can't handicap at all.
Yeah, well, I think it's of all of them out there, the Chinese are probably the hardest to predict what they will do of everybody, I would say.
Completely.
I think Mexico and Canada have to just resolve this as quickly as possible. Because they're going to feel it quickly and miserably.
Well, like I said, 25% of your GDP is exports to the United States. You're not exactly holding a lot of cards.
You can't swallow that. Now, my next question is today, I guess it was Apple and Nike announced they're already starting to increase prices based on the tariffs. So is there any way their supply chains are already being interrupted based on inventory on hand to do this? Or do you see these major corporations never wasting a good crisis to try and increase profits? What do you see happening there?
Oh, I think they're probably increasing their prices because they have to, because these tariffs are very punitive for them. I don't actually.
Do you think it's happened this quick, though? Do you think it's happened this quick?
That I don't know. I can't answer that question. I don't have enough information to know that one way or the other. I think Nike and Apple are going to have. Look, you can't rejigger your supply chain from Vietnam and China to the United States overnight. It doesn't work that way. Factories, unfortunately, can't be built overnight. That's just not how it happens. So does that mean that there are going to be higher prices for certain goods in the near term? Probably. This is not going to be a seamless transition.
Well, let me ask you this. One of the seemingly, like you said, the towns that were decimated by NAFTA, by the auto industry moving to Mexico, all of these things happening, How feasible do you see? How feasible do you think it is for the United States to really move mass manufacturing back to the States? How feasible is that?
That's a great question. I think it's feasible. It's going to take time. I think one of the things that I'm guessing will help is, right now in Congress, they're hornswoggling about taxes. And I think one of the things that will be proposed is if you build a factory in the United States, and I think it'll be backdated to the beginning of the year. Mm. So if you build a factory in the United States, you get 100% write-off.
I think
that's pretty wild.
Yeah, it is. It is. But don't you think that some of the reason that manufacturing left in the first place was organized labor in this country just put such a chokehold on manufacturing with making the cost of labor so expensive that it forced this, or was it really just about corporate bottom line?
Well, some combination of both, but unions are much weaker at this point.
Do you think they're going to have to make concessions to get manufacturing back?
I think companies will probably choose states that don't have strong unions, is my guess. So if I had to take a guess, which states do I think are going to benefit the most? You'll see them in the South and the Midwest outside of union strongholds. That's just a guess.
I know. It's so funny to think that all of this kind of comes down to a handful of people acting rationally as they should. There's just no guarantee
that's part of the problem with economics is when you peel it back, you realize that one of the major assumptions about economics is that people act rationally. And one thing I know from watching my screens every single day on terms of stocks is the last thing people do on most days is act rationally. They act emotionally.
What do you think the best case scenario is for timeline for this to somewhat get resolved? And the worst case scenario is? What would you say?
The best case scenario, I think, is 2 to 3 months.
2 to 3 months.
Yeah. That's pretty quick when you think about it.
That is quick. Yeah, that's fast.
And the worst case scenario is a full blown trade war.
Mm-hmm. How far? So if it goes 2 to 3 months, do you think your average American is going to experience pain? Will we have time to experience pain there? Or will it just kind of resolve before we got to massive interruptions in supply chain?
I don't know. That's above my pay grade, man.
You're the smartest guy in the room, and I'm
that is way above my pay grade.
You know what? In your defense, that's how you maintain the reputation as one of the smartest guys in the room, is you don't talk about things you don't necessarily know.
I actually I don't know. I really don't know.
I don't know.
Don't know.
All right. Well, as a sharp investor, right, as someone that invests, obviously you're a Wall Street legend, as somebody that is a sharp investor, how are you looking to take this situation and make it a positive for investors?
So what I would say to people right now is this is not the time to be a hero. First of all, any analysis. On my own podcast, the Eisman Playbook, I had my old partners on last week, which we just posted. And we were talking about, if we were all still together running our hedge fund, what would we do? And I think we all concluded that we would not press shorts. We would just take the book down on both sides. We would just de-risk and we would sit and wait. And the reason is that when, in normal times, there are a lot of different variables that move markets and move stocks. And right now, that whole world is out the window. There's one variable that matters, and his name is President Donald Trump. And that means volatility. So what I would say to people is, if you're literally having a conniption fit every single day and you can't sleep, and Lord knows you need to sleep, sell some things in your portfolio. Sell positions that are not your favorite positions. Maybe even on some of your favorite positions, sell a little. You'll feel better.
Yeah.
And wait. Just wait. You don't have to be there for the first uptick if things get resolved. Because if things get resolved, it'll be uptick for a very long time. The downside risk here from I think the risk of a trade war is less than 50%. How much less than 50%? I don't know yet. But that's not infinitesimal. So if there's a full-blown trade war, the market would go considerably lower. I can't handicap for you right now.
If everybody settles except for China, would we still consider that a trade war?
No, I would not consider that a trade war.
You'd consider that China becomes an outlier to the problem.
The outlier to the problem. I think that's dealable. That can be dealt with.
Okay. All right, fair. Because I think it seems like everybody puts so much emphasis on China's reaction to what happens here.
They certainly did that on Friday.
Yeah, they did. But down 10% was their market
Which
down
was sort
10%
of weird. What did you expect? Did you actually seriously think that China was not going to retaliate at all? Of course they were going to retaliate. They had to.
Yeah.
They had to save face.
Well, let's get back to the retail investors here, because obviously traditionally speaking, when the market falls like this, the money runs to bonds, which then drop the yields on bonds. And for what I do, obviously real estate, we're so intimately tied to that 10-year treasury bond, which fell under 4%, but then bounced yesterday back over 4%, which I thought was really strange. What's your thought there?
I didn't understand that move, other than people were trying to buy stocks and so they were selling bonds. Otherwise, it made no sense to me. I would suspect if things stay hairy for a while, yields will go back down.
Okay. Because obviously for what we want to do, and this is where your kind of crossover of knowledge becomes so interesting to me. How do you think this affects the real estate market? Where are we going from here?
Well, if we're talking about residential real estate.
Yes.
As we all know, the residential real estate market is locked right now. And it's locked because of COVID. And the reason why it's locked because of COVID is that everybody with a pulse refinanced their mortgage at 3%. Mm-hmm. And today, if you take out a mortgage, what's the latest rate? 6.5?
No, well, that's the thing. With the bond yield going down on Friday, we got to 6.5, but as soon as it came back, we bounced back up to 6.75.
Okay, so call it 6.75.
Yeah.
So one thing I learned very early in school is that 6.75 is more than 3.
3.
In fact, it's more than twice as much.
Yeah.
and mathematically, that's a problem. My guess is mortgage rates would have to go below 6.
Yeah.
to get the residential market unlocking.
My magic number for that is 5.5. I think when it hits 5.5, there's an onslaught of pent-up demand for people that needed to do something that wouldn't, they're not going to swallow 7 from 3, but you'll swallow 5.5, especially if the pain in your current living situation is great enough. Right. You'll swallow that and make them move.
I mean, if your kids are climbing the walls and they got no place to sleep, you're gonna not to 7,
not to 5.5. So with this going on, if you had to look back at the housing market now, is this a bet you would make for it or against it going into the spring, which is traditionally our busiest time?
I think there's just so many variables. I wouldn't be making any bets right at this point. It's just too hard.
Like too many variables to make.
It's all down to one variable. It's one variable. It's all one variable. Markets are very, very difficult. If you go back to 2008, the variable was the balance sheets of the large banks, and everybody was trying to do detective work on what they had. It turned out they had a lot of bad stuff, and that was a bad variable. Today, the variable is the president of the United States, and and he hasn't called me, so I can't give you any insights.
Yeah, he fired me on television once, but he hasn't called me recently either. Yes. So there you go. I get kind of what he's trying to do. And I understand that it could go very quickly. So how long do you think, if there's if there can't be movement here, let's say it's a stalemate and we really start to sting here, do you think, knowing what you know about him and seeing what you've seen, that he starts to back off this?
No way.
He's all in on this.
He's bet his presidency on this.
This is it.
This is it. You can't put all your chips into the poker table and then say, sorry, and take them back. Then you look like a fool.
Is there one of the players that's out there that we're currently negotiating with, you think if they fall, all of them fall? Because like the EU, I think pretty strongly came to the table this week, if I'm not mistaken.
Yeah, but it's going to take time. I really do think they're all going to come to the table. I think they don't have a choice. This is the most important. Our consumer is by far the most important entity in terms of economics in the world. You have to be here. You can't be Mercedes-Benz and not sell cars in the United States of America. The company doesn't function. So, like I said, I feel pretty good that people will be rational enough that they'll try and work out as good a deal as they can. That's going to take time. This is complicated. I mean, you're talking about tariff, VAT, and any other kind of regulatory restriction stuff that I don't really even know enough about. I just know it exists.
Yeah. Well, they flat prohibit, Ford Motor Company from selling their cars in certain parts of the world.
Right.
Yet we import cars from
we import everybody. Everybody's free to come here.
Yeah, it makes no sense. Let's talk about The Big Short. Let's talk about that for a little bit. So let's go back in time. Obviously, that was I lived through that. I've been in this business a long time. Las Vegas was ground zero for the financial crisis. And I have some
good scenes in the movie in Vegas.
Yeah, they're inaccurate scenes. I mean, literally every stripper in this town owned 3 houses. Just kind of how it was.
I wouldn't know anything about that.
I have a question. Let's talk about the semantics of the movie first before we talk about the actual situation. So, what is it like when you're sitting there and they're like, "Okay, Steve Carell's going to play you"? What's that like?
Well, it's actually a little bit more complicated than that. So, more amusing. So I think in the fall of 2014, Michael Lewis called me because the rights to his book were sold right after he published it, which was something like 2010, and then nothing happened. So I figured that is never going to happen. So then in 2014, I think it was like October, he called me and he said that that the movie was going to get made. And Adam McKay, who was this writer,
Step Brothers,
et cetera, had written the script and was going to direct and was going to call me. And I go, yeah, sure, Michael. Nice talking to you. And sure enough, a week later, I get a phone call from Adam McKay. And it was kind of a funny conversation. He says to me, he's written the script. He's going to be in New York. He wanted to come have dinner with me. And I said, sure. And then he said, we're trying to cast it. And at this point, it's quite possible that Brad Pitt's going to play you. And I said, listen, let me just interject here. I said, the only thing that Brad Pitt and I have in common is really good hair. And that's it.
Yeah.
And I do have very good hair, I have to say. But that was all we had in common.
And there's a chance your wife loves you both. there's a chance.
And there is a chance that my wife will leave me for the guy who's going to play me.
Yes.
So then it turned out that he couldn't do it. He had scheduling conflict. He took a much smaller role in the movie, and Steve Carell played me. And I met him like twice. That was it.
That was that.
Yeah.
So the scene in that movie, I think probably your character's most famous scene, and I think it was based on a real event, is when Ryan Gosling's talking about you coming to Vegas to the mortgage bankers convention and you raise your hand and ask a question. Did that really happen?
Venetian.
Did that really? Well, walk us through the real scenario of what happened.
That really happened. It was a little bit different in that the way the movie depicted it, it was like a massive meeting, and it was actually not a massive meeting. It was a medium-sized meeting that was hosted by Option One, which back then was a subprime mortgage lender that was owned by H&R Block. And I was sitting in the audience with my partner Danny Moses. And the scene about where he goes zero probability, I did that because I was that obnoxious and rude back then. and as soon as I say it, my phone rings, and I look at it, and it's my wife. And I turned it in, and I go, I got to take this. I got to get out of here. And I picked up my wife, and I walked out. And that is what happened.
So, I mean,
by the way, Danny literally crawled like under the chair.
Oh, I can imagine he would have. I can imagine he would have. When that was going on, let's talk about the moment in that moment, when you saw that potentially happening. What did you see in the markets at the time that you thought this might become something? And has there been any parallel since in the real estate market?
So let me go back a little bit because I have a very, very long history with the subprime mortgage industry. In fact, when I was a sell-side analyst at Oppenheimer in the 90s, and I covered a whole bunch of different financial services companies. And one of the subsectors that I covered was Generation 1, I like to call it, 1.0 subprime mortgages. You know, companies like, if you remember, like the Money Store. Remember Phil Rizzuto for the Money Store?
Oh, sure. Yeah.
So that was one of the companies that I covered. It was run by a guy who was the son of the founder. I think his name was Mark Turtletaub. And in 1998, for various very complicated reasons, most of the sector pretty much went bankrupt. And I lived that. And that was a very searing experience for me. And the irony was that across the hall for me was Henry Blodgett, who was a young analyst at Oppenheimer, and he was getting on the call talking about how the internet was going to take over the world, and this is a direct quote: "Dynastic levels of wealth were going to be created." It's one of the greatest predictions in history.
Dynastic levels
of wealth were going to be created.
And he was right, from the internet.
And he said this in 1998, and so here is Henry Blodgett talking about dynastic levels of wealth, and I have a subsector that went to dust. Mm-hmm. So after I left Oppenheimer, I went to a hedge fund, and then in 2000, and I started at Front Point in 2004. But in 2002, Subprime Mortgage 2.0 went public. And the funny thing about Subprime Mortgage 2.0 was that it was run by the same CEOs who ran 1.0. They just changed the names. So as early as 2002, I said to myself, I've seen this play. It's a play in 3 acts. People don't change. It's a play in 3 acts. Act 3 is going to be a tragedy. I'm just going to be there when it happens. When that will be, I don't know. Mm. Now, what I didn't foresee in 2002, that the industry would literally be 10 times bigger in 2006 than it was in 1998. Mm-hmm. Yeah, I think in 2002, the subprime mortgage industry originated like $50 billion. And in 2006, it originated $500 billion.
Well, didn't Clinton also incentivize banks to do this through some policy that was made? Was it him that did that?
It doesn't ring a bell.
Okay.
They didn't need an incentive. They made tons of money without any government incentives. Believe me.
Fair.
So I was waiting. When you're waiting for something to happen, you look for evidence that it will happen. And what I saw was that by the summer of 2006, we had access to Moody's securitization data. All the securitizations report all their credit data every single month. And by late spring, early summer 2006, it was very clear to us that there was something was wrong. That delinquency levels in these new pools were going bad very, very rapidly. And that's when we started to investigate the shorting subprime paper. And then there's that scene where Ryan Gosling shows up in our office. That happened. That was a guy named
with
Greg
with the Jenga tower.
Yeah, all that stuff happened.
I mean, it was a great way to definitely talk about what was going to happen there. Do you see any parallels between that time and any of the real estate markets since?
I actually don't.
Yeah.
First thing I would say is I don't think a subprime mortgage has been made in the United States since 2008. Not at least not that I'm aware of. And the other thing that I would say is that after Dodd-Frank was passed, a new position in the Fed was created called Vice Chair of Financial Supervision, and that's a fancy name for Chief Bank Regulator of the United States. I mean, it's a crazy thing to say that the United States never had a Chief Bank Regulator until 2011. And that position was occupied by Fed Governor Daniel Tarullo, who's truly one of the unsung heroes of the last 15 years because he really did an amazing job. He de-risked the banks. He de-levered the banks. So, I worry about a lot of things. I don't worry about the health of the U.S. financial system anymore.
The reason I asked that, it was kind of a loaded question. I figured you were going to say no, because being in the business that we're in real estate, you're constantly talking to people that are pocket I'm just waiting for the market to crash. Buddy, it's not going to happen again, because I try to explain to people, equity doesn't go to foreclosure. Somebody steps in to take that. Yeah, somebody comes in to save that deal way before it hits foreclosure. Equity never goes to the steps. And for some reason, people still in the residential world can't buy that. And I don't get it. So let me ask you this. If you were somebody right now, and again, self-serving for me, you're a great understander of the markets. Would you hold off on buying anything right now? Or what would you do? I mean, I'm talking about.
I can only tell you what I'm doing.
Okay, perfect.
I sold a few things that I didn't have great confidence in, and I'm sitting on my hands. That's what I'm doing.
So where do you think all this cash is? Because there's a lot of investors doing the same thing. Are there just absolute war chests being built up by hedge funds?
Hedge funds, I guarantee you, have de-risked, and they're waiting. And so there's a lot of cash on the sidelines, but that cash is not going to get deployed until there's clarity.
They're sure. All right. Well, I want to ask about one more thing that has nothing to do with anything you might know about, but I just wonder if you have an opinion, which is this. Now, in the last couple of weeks, it seems like Elon Musk and the Doge department wants to take aim at our elected officials for how does somebody that makes a couple $100,000 a year become worth tens of millions of dollars?
It's a good question.
And is that something that you feel needs to be looked into? Where are you with politicians that somehow become overnight millionaires in the stock market and they're the best traders on the street?
Well, do I think it should be investigated? Sure. Any type of corruption should be investigated. Do I think that's going to move markets? I don't think that's going to move markets.
No. Do you think that? What do you think? How much would our government change if we took the ability to trade out of our legislators' hands?
I don't know. I honestly don't know. That's a good question. I've actually thought about it. Yeah. I'll think about it. I'll get back to you.
That's good. See, this is the podcast that makes you think, Steve. That's what I'm trying to do.
I'm going to think about that one.
Which is good. Let me ask you this, because with the rise of AI, I just talked to R.A. Mizell not too long ago, and we were talking about AI, and I actually asked him do you think maybe there's some thinking within the White House about bringing manufacturing back to this country where AI is replacing low-level workers at just an alarming rate? Do you think they're trying to bring manufacturing back in anticipation of having sort of a job shortage?
I don't think so. I mean, it certainly may give them more impetus, but I think Trump has been thinking about this for a very long time, way before there was AI. That was an issue.
So even in your industry, how is AI changing what you guys do?
It helps research. It helps. I mean, the access to information. You ask AI a question. If you want to find out, certain information that was more difficult to research in the past, boom, you get an answer now.
Is it making your job harder because the speed of information is so much faster?
I would say no. I think I'm going to say something a little radical. Information is overrated, and let me explain what I mean by that. People think, when they talk about what my partners and I did in 2007 and 2008, that somehow we had access to information that other people did not have, and that actually is not true. The most important, there was a lot of different types of information. There was anecdotal information that we did a lot of. But the most important information out there was the securitization data that came out every single month. Mm-hmm. And all you had to do to get that information was pay Moody's about $15,000 a year. I think that's what we paid.
Well, I think
whatever it was. But you know what? The entire fixed income world had that information. And
they just didn't understand how to look at it.
No, they understood how to look. They understood how to look at it better than we did because they've been doing that for years. We just interpreted it differently. They had made money for so long in this paper that they came up with all these psychological excuses. Well, yeah, the data is bad, but it'll get better. And so my view is that information is important, but it's the interpretation of the information that's even more important.
Well, it's funny because I was just talking about this with somebody else where we were talking about how Wharton has become, which don't get me wrong, I'm not a Wharton grad, but we're talking about how Wharton has become this school for great operators, and more CEOs come out of Harvard than come out of Wharton. And I said, why do you think that is? And they said, because I think Wharton's school of business is very linear thinking. It's very this to this must equal this. Whereas they felt that at Harvard, it taught more open-mindedness in a way to interpret the data. It's because this person was saying there's science in the numbers, there's science in the math, but there's also got to be art and nuance to the interpretation, which is what makes big moves in the market, big moves in business. Is that something that you? Yeah, is that something? Is that something that you guys?
I have nothing great to say about the University of Pennsylvania, by the way, because I went there. I got a lot of problems with the school.
Did you? So I was not aware there was a war between you and the University of Pennsylvania when we started that question.
That's public knowledge.
I was not aware. Is it public knowledge?
It's public information. Yeah.
All right. Well, ChatGPT did not return that for us the year war, so you might need to update your model to that. But now I'm going to go look it up. I'm going to go find it.
You should look it up.
I'm going to do that. Well, Steve, thanks so much. If they want to find you, if they want to connect more with you, how do they find you?
Just go to theeismanplaybook.com. That's our podcast website. We'll soon have another website, which will be broader. It'll be steveeisman.com, but it's not up yet.
Okay.
And I'll be dropping a podcast pretty much once a week.
Perfect. We look forward to listening to that. And let me ask you one more question before we go on.
Sure.
Because I think this is one of the biggest problems with the world right now. And I want to know your process for this. How do you decide where you get your information? Because there's so much of it out there. How do you decide this person's qualified, not qualified? This is a good source. That's a bad source.
I mean, I'll tell you what I read, and then I'll tell you who I focus on. Okay. I read the newspapers every single morning. I come in, I turn on my Bloomberg, and I look at the news. And then what I do is I read a lot of sell-side research. And what I have found over the years is that, and there are exceptions to this, but generally speaking, the boutique firms, little firms that most people haven't heard of, not the Goldman Sachs's and Morgan Stanley's of the world, although there are good analysts there too, tend to produce research. It's a lot, sometimes you could say unbiased, but I would say deeper dives into what's happening. And I tend to learn a lot more from those people.
Cool. All right. Well, thanks so much. All right, guys. Man, I hope that helped you today and you actually have some information when you're sitting around the dining table with your mother who knows more about it than you do. You have some quality information from the man that probably knows more than all of us. But remember, man, I think if anything else, be careful where you get your information, because if you just start repeating something that's nonsense, it makes you look like nonsensical as well. We'll see you next week. What's up, everybody? Thanks for joining us for another episode of Escaping the Drift. Hope you got a bunch out of it, or at least as much as I did out of it. Anyway, if you want to learn more about the show, you can always go over to escapingthedrift.com. You can join our mailing list. But do me a favor, if you wouldn't mind, throw up that 5-star review, give us a share, do something, man. We're here for you. Hopefully you'll be here for us. But anyway, in the meantime, we will see you at the next episode.